So anyone who's watched my videos or followed my content knows that I am a big fan of real estate investment trusts or REITs, specifically those that have a lot of net leased properties, which is a very favorable lease structure for the landlord. One in particular that is on my radar right now and is on a lot of people's radar because of something they're about to do is W.P. Carey. Ticker symbol is WPC. Before we dive into it, take a minute and check out the link you see on your screen for a message from my sponsor, The Motley Fool. It's the best way to support this work Tyler and I are doing, and you can get the top 10 stocks to buy right now. So, if you're not familiar, WP Carey, as I mentioned, is a net lease REIT. It's generally a leasing arrangement that applies to single tenant properties, and it involves a long term lease, and the tenants are responsible for certain variable costs, specifically property taxes, building insurance, and most maintenance. So, the theory is that all the landlord has to do is sit back and collect a growing stream of rental income. WP Carey is kind of a rare case in that it has a very diversified portfolio. Most net lease most net lease REITs specialize in one type of property, such as retail properties in the case of Realty Income, or gaming properties in the case of Vici properties. But WP Carey has industrial properties, they have office properties, they have retail properties, they have self storage properties. It's a pretty diverse portfolio. Now, they're about to get rid of one of those types of properties, and that's what makes this such an interesting opportunity. Before we dive into that part, the stock itself is down by about 37% from the highs, and because of that, its yield is now up to almost 8%. So, Tyler, why don't you talk about what they're planning to do and how it affects the investment thesis and just kind of your general thoughts on it?
Sure. So what's going on is, as you mentioned, they have a very diversified portfolio of net leases, but that doesn't necessarily mean that all of those asset types are great to be in right now. And one that WP Carey had in particular that it wasn't a huge fan of anymore was office. And understandably so. We've seen a lot of office properties, United States and even globally, vacancy rates are going way up. You're starting to see basically repricing of office properties way lower than we had seen pre-pandemic, and there doesn't seem to be that big catalyst that anyone expects there to be that's going to change that anytime soon. It's starting to trickle back, but not enough that anyone really wants to be loading up on office properties right now. So what right now, as of the announcement that they made a couple weeks ago, WB Carey had about 16% of its rent roll in office. But what it's going to do is it's going to spin off a majority of its office properties into a new REIT that's going to be managed by WP Carey. And in doing so, it's going to reduce WP Carey, the parent company's exposure to office down to about 5.8, and then it's going to eventually sell those off. The stuff that's left on the balance sheet is going to be international real estate. It's actually most of the tenant is the Spanish government, so it's going to sell those off to unload it rather than fold it into the REIT. And the goal here is if we sell this or we spin it off, we can more or less reallocate more of our time and capital into industrial real estate, into retail, into self-storage, places where they think it has higher growth opportunities, better investment opportunities that over time will allow it to grow a little bit faster. And if there has been one knock on WP Carey for a very long time, it's been sclerotic dividend growth. It's been one of the higher yield paying companies in this industry, and the value proposition for them for so long was we're going to be very stable. We're going to pay a yield that is backed by net lease properties. We're very well diversified. So if something goes wrong in one, we're going to be okay. And all of that it resulted in, a couple of years ago, we're talking a yield 4 or 5%, which for REITs at the time was pretty good. But with rising interest rates, with kind of the death of the office, I don't want to go say that much, it's pretty hyperbole, but declining attractiveness of office investments, that has changed the dynamic for WP Carey. So they want to offload that and hopefully use this as an opportunity to accelerate growth. Now, you mentioned an 8% yield today, and part of the reason that you're seeing that is as a part of this spinoff, management has discussed what they're calling a dividend reset, which is a nice euphemism for dividend cut. When they spin it off, there's obviously the new investors in W.P. Carey are going to get shares of this new office property, but at the same time, the existing shareholders will have a lower dividend. And what management has said is that under the new dividend for the remaining company, they're targeting a payout ratio of the low 70s in terms of funds from operation, allowing it to invest more in higher growth opportunities, better reinvestment opportunities, which in theory makes sense, right? Like I said, sclerotic growth for a long time. Its payout ratio is creeping up into the mid 80s, which is not bad, but you're not going to get a lot of growth out of that because you do want to leave a cushion. So all of this kind of adds up to a situation where it looks like things could get better, but obviously with this cut, the market is kind of pricing that in, that it's not going to look as attractive as that 8% yield says it will today.
Yeah, no, I would agree with that. It's definitely not a great time to have office properties, especially those that aren't like iconic or great quality. Like the one office REIT that I still own is Empire State Realty Trust. And there's a solid case to be made that iconic properties like the Empire State Building are going to do just fine, especially if they're well funded and the REIT is well capitalized like that one. But this spun off REIT is going to have a lot of debt attached to it from day one. And there's nothing particularly special about their office properties. There's actually heavy tenant concentration, which is a red flag for me. Um, I'm definitely not a fan of the office REIT. If I owned WP Carey today, I would probably sell the office spinoff when it comes in and just buy more shares of WP Carey, which is exactly what I did when Realty Income spun off its office properties a few years back. Um, Orion Office Properties is Realty Income spinoff that still exists today, has not performed well, and I can see kind of a similar thing happening here. It's just going to be called Net-lease Office Properties, which is probably the least creative name for a REIT I've ever heard. And it's just not a great one. But as far as WP Carey's portfolio goes, there's a couple of potentially positive effects once the spinoff takes place. Number one, net lease REITs generally rely on growth to kind of boost their earnings over time. They do this in two ways: by selling stock and raising debt, neither of which are very attractive right now for WP Carey. As I mentioned, shares are down by 37% from the highs. I have to believe that high concentration of office properties relative to its peers is weighing on its valuation and making it more difficult to raise capital in an efficient manner. So this could have that effect. It could help bring its valuation more in line with peers, which could make raising capital a little bit more attractive. The spinoff is definitely a net positive for WP Carey. I'm still more of a fan of Realty Income as far as a long-term investment, but there's a solid case to be made that this is a good investment, especially after the spinoff takes place, if its valuation doesn't, immediately spring upward. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.